welcome everyone. We're just going to wait for about 10 or 20 seconds just till a few more attendees jump on to our Zoom presentation from Rees Group and Discover Financial Partners. We'd like to thank you for taking the time out in your morning. Very busy time for everyone at the moment, and there is quite a bit of uncertainty. So most of you know that Rees Group and Discover work in the same office, so we're all working remotely at the moment, but we thought it would really be relevant that we come to you and feed you with some information, and we've got quite a broad range of information to run through today. We'd also like to welcome our friends from easytaxback.com. We've got a couple of clients that have logged on as well to hear about the stimulus update and also the investment update that the gents will be running through. So thanks again. There's lots of questions from everybody. We thought we'd be a little interactive today. We've got a menti.com, menti.com feedback system running. So I might just ask every attendee, and we know that we've got in excess of 50 people attending today, which is fantastic. If you imagine 50 people in a room, it's quite a few. We couldn't imagine that because Scott has told us that that's not possible now. But just one word to describe COVID-19, the coronavirus pandemic, and how that makes you feel for you or your business. If you can jump onto Menti on your phone and just pop one word in, enter the code, the 866028 code. And that'll come up on screen for all of us just on how you're feeling in relation to this current pandemic. We will wait a little bit, and I will just say that I'm old enough to have been working through the tech wreck of 2000 and also the GFC. And a comment I'll just make about the GFC and now is this is a lot deeper, and I think there's different opinions as to how we're going to recover. I think we'll recover faster, but I don't think we're anywhere near the end at the moment. I think there is a number of things to happen, and I don't know if you saw Scott Morrison last night or even Daniel Andrews this morning. You know, they are preparing for the next stage. So I think that's one of the messages for today too, is preparing for the next stage of potentially shutdowns. And you'll see here on screen just on, you know, this is the new world changing is one of the words that people have come up with there. I think, you know, I think the social distancing side of things, the way that we're running our businesses, all that's changing. But I think ultimately we're all very resilient, and we'll come through the other end. So I'd like to introduce our panel today. You should be able to see all of us. There is Matt Gibson, the owner of Discover Wealth and head advisor. Welcome, Matt.
Morning,
and
everyone.
David Meffert, who's a is a new member of the team who comes on board to our team last year. So David's an investment advisor. He'll be giving a part presentation as well. I think the important thing is there's a chat function on the webinar as well. So if you notice, we have a Q&A area on our screen. So if you put your questions in whilst I'm talking, while the other guys are talking, at the end we're going to be coming through the questions and running through those as well. So just so everyone knows, the attendees of the webinar, because a few of my team are asking as I'm talking and distracting me, is that we can't hear you. So the only way you can communicate with the panel is through the question and answer. So if you just keep that that coming through. So we'll start my part of the presentation, which is in relation to the stimulus. And I wanted to talk about the three areas of the stimulus that's been put forward for keep calm and keep watching. There's been obviously a lot of video content that's been going around for everyone, but the stimulus has been in two parts: 66 billion on Sunday, and the initial part totaling 189 billion, $189,000 million of stimulus. So I don't think it'll be the end of it. I think there'll be more to come, but I think what we want to do is break it down to 3 sections for you. So obviously the impact on individuals, the impact on your business, and I do want to talk about an area that seems to have been not skirted over, but it's been sort of skimmed over by the media, which is the regulatory shield in relation to some of the changes to the corporations law that's happened and passed Parliament. I think it all passed Parliament on Monday night. So let's just talk about individuals first. A lot of what the government has done is all about injecting money into the economy for individuals. We've seen obviously anyone who's been involved in hospitality, travel, all those areas really being affected quite aggressively. And as I said, I think there is definitely more to come. So household support is really what the government was focusing on for self-employed, part-timers, and also to retirees. We've had some questions from people who have, lost jobs, whether they should be approaching to apply for the job seeker allowance through Centrelink. Absolutely. If you qualify and you've lost your job, the actual job seeker allowance has been doubled. The fortnightly payment has been increased by an additional $550 a fortnight, essentially doubling that payment. And what's great about the job seeker allowance is that the government has waived the asset test. So no matter what your own home is worth, if you've lost your job, you're entitled to jump on, as we've seen by the website crashing on Monday night, but you're entitled to jump on and apply for your Centrelink. There is also two amounts of one-off stimulus payments, one in April and one also then on the 13th of July, and that's a $750 payment for anyone who is receiving any benefit from the government in relation to Family Part A, Family Part B, job seeker allowance, pension payments from the government, disability payments. You'll receive 2 lots of $750, so $1,500. And I think that'll go a long way. I don't know about everyone at the moment, but my whole family's at home at the moment. We're working from home, but I think, we're spending money on food, but a lot of families are not spending money on much else. So that $1,500 will go a long way, even though it's spread over 2 payments. There is another avenue that was released in relation to super, and Matt and Dave will come back and circle around on super, and that's in relation to accessing superannuation. So if you're a sole trader or employee and you've had a fall in your hours of more than 20% of your hours or income, then you can access your superannuation. So yes, you are accessing your own money, but I think in these times where cash is king and the ability to access money is really important, I think if you're an individual and need access to your superannuation through your superannuation fund and the hardship provisions within super, you'll be able to access $10,000 up to $10,000 this financial year, and then $10,000 after 30 June into the next financial year. The last one on the slide here that I have is in relation to superannuation pensions. So we have a lot of clients that have logged in, and Matt and Dave have a lot of clients that are in pension phase with either their industry super fund or their self-managed superannuation fund. And it's age-based, but it's based around, at the moment, you've got to draw a minimum of 4% every year of your pension payment, of your asset value of your retirement benefit, you've got to take out in pension. That's been halved, and there is a sliding scale relating to the age of retirees, but essentially if you're drawing 4% minimum, you now only have to draw out 2% minimum. And the idea there is to enable you to leave money in superannuation to allow those investments to increase over time. And Dave will run through the impact of being in the market and leaving money within your your superannuation fund to enable it to progress forward. So that was the first part, and we'll come back, as I said, in relation to questions in a moment. The second part is in relation to businesses. So this is across the board. So we've already seen some businesses in shutdown, and I think the important part is to understand the federal government is not essentially handing us money, but they call them cash payments, but through our tax system, essentially the BAS system, the BAS that's due to be paid at the end of April, which is the March BAS, each business will get at least $20,000, 10,000 this side of June and 10,000 after June, and up to $100,000 based around the PAYG, the pay-as-you-go tax that you've paid for employees, and that means you must have been employing employees from the 1st of January this year, and we've had a couple of new businesses that have started employing from the 1st of January, so they'll be entitled to be claiming on the March BAS for essentially the government is rebating back the PAYG back into the system. So they are giving us money because we're not having to pay that PAYG. That stimulus alone is going to be $31.9 billion of stimulus back in. So there's no new forms, there's no new cash payout there. But that'll be done through the BAS system. I think there'll be more of that to come. That's just a personal opinion, but we'll have to wait and see as to how far and deep that runs in the future. But obviously, with all of our clients, that's something that we're all across. In relation to businesses, actually, at the end, I'll just talk about the lodgement program for BATs and payments to the ATO. The second main part is a 50-50 partnership, which is guaranteed lending for small businesses. So loans of up to $250,000 for 3 years. Now, these are mandated loans by the government, which are guaranteed, part guaranteed by the government. They are an interest-free loan with no payments for the first 6 months. And they are for an amount of up to $250,000 for a maximum term of 3 years. So the idea there is they want to reduce red tape, and they want to enable us to borrow money in business from our existing bankers. So from the 1st of April next week, there'll be separate sections. There are separate sections within the bank. We know that there's some clients that have already not necessarily applied, but inquired with their business bankers. There'll be separate sections within the bank that you'll be able to apply for these loans. Hopefully they're turned around quite quickly because they're government guaranteed. It is money that you need to pay back. So something I want to stress there is that you don't want to be borrowing money that you don't have to if you have significant cash reserves. But for those clients and those businesses that are sailing close to the wind, I think this buffer will enable you to keep people employed and keep people employed potentially on a reduced rate in some cases, but also to keep your business robust for when we come out of this. Because I think when we come out of the cycle that is going to last for a while, those businesses that are cashed up and ready to go and ready to promote their businesses and be on the front foot are the ones that are going to benefit in the future. The next one, which was a state-based payroll tax refund. So this was announced by Daniel Andrews, and this is a tax refund. So anyone who's paid, any business who's paid state payroll tax in Victoria, I'm not sure about New South Wales, I haven't checked before the webinar, an employer of up to $3 million in annual wages for the 2020 year, this week we'll be contacted by the payroll tax, I believe from today to Friday, by the State Revenue Office, and this week we'll be receiving a physical payment of payroll tax being refunded. In some cases that's $30,000, $40,000, $50,000 going back to clients, back into their bank account, and it all helps. So I think I'd have to commend Daniel Andrews for that one. I think payroll tax is quite a prohibitive tax, and that was a fantastic initiative by the state government. The last point in relation to businesses that I wanted to state is this. Last Monday, trying to get a payment arrangement for a client with the ATO was as difficult as it has been in the last couple of years. By last Thursday, the ATO was a lot more lenient in relation to how much time they will allow you to pay back amounts that are owed to the ATO. So whilst it's not great to accumulate an ATO debt, preserving cash is important for your business. We are advising a lot of clients at the moment to look at whether or not they need to defer some ATO payments, contact the ATO and apply for hardship with the ATO. And in many cases, we've had clients be allowed a 6-month window for repayment of some debt or significant reduction. So instead of paying $10,000 a month, an example was of a client paying $1,000 a month. So a $9,000 a month saving just in this really difficult period, I think is a fantastic saving. So just keep that in mind for your business. Contact ourselves if you need some assistance there. We're constantly on the phone with the ATO. It's taking a bit longer than normal at the moment, but that is definitely happening. I will keep moving in the interest of time and just jump across to the last point, which is the regulatory shield. So the government has changed the Corporations Act temporarily in relation to trading whilst insolvently. So the very last one here is, in the past, as a director, you could be held liable for trading whilst insolvent if you knew that you couldn't pay the debts of the company. We always seek advice from specialists in this regard, but the government has made it very clear that they want people to keep their doors open and have a crack. So I think the important part there is that if your business is on the edge and for some reason after the shutdown it doesn't continue, personally as a director you shouldn't be worried about whether or not that's going to affect you, because you can't be taken to task by ASIC and the regulatory bodies for trading whilst insolvently. They want to give us 6 months to trade through this period. Tax back from the state government, PAYG back from the federal government, loans half guaranteed by the federal government. They want us to trade through. That's really, even if there is a total shutdown, they want us to trade through that period and then out the other side. And one other thing was there's a credit, what's called a creditor's statutory demand, where in the past, if you owed someone more than $2,000 and hadn't paid them over a period of time, they could issue what's called a creditor's statutory demand. That limit of $2,000 has been raised to $20,000, and instead of 28 days for someone to come back and respond to pay the debt, you've got 6 months to go back to that creditor and repay the debt. So this is all about companies continuing, companies keeping their doors open, creditors not being able to essentially close down a client if they've been slow for whatever reason. This is all about keeping our country going and keeping people employed to ensure that that happens. So I hope that those three main areas that I've run through have been informative. I am going to hand across to Matt Gibson. As I said to you, I think the recovery is going to be a lot faster when it does happen, and we're a little bit away yet, but I really want you to think about the different stages of planning for your business and planning for the next stage, and the assistance that the government, and we can help you with that, and the banks can give you through that period. So thanks everyone for listening, and Matt Gibson, I'll just hand across to yourself.
Great, thanks Justin. Morning everyone. So I'm just going to change gears a little bit and talk a bit more about the personal finance impact, or the impact of the crisis on personal finance. So if I could just have the next slide, thanks Sarah. So I guess first of all, it can feel a little bit like I heard somebody said to me the other day, it feels a bit like an alien invasion, stuck in our homes waiting to see what will happen. And I think if we look at the markets, it's also been a very foreign response. We've seen the markets really correct at a rate much faster than we've experienced before. And I think it makes it hard to kind of put a baseline around what we can expect going forward using history as a lens. But I do want to go back and think for a second about the SARS outbreak. So back in March 03, we had the SARS outbreak. We had peak virus hit in late March 2003. And then we saw the Hang Seng and the airport stocks drop over that time. We then, I'm just checking, you haven't lost me. 1 second. Can I just get a thumbs up? You've still got me? Good. Sorry, my screen just blacked out.
Yeah, I can hear you, Matt.
Okay, great. So back to the SARS outbreak. So 03, we saw the Hang Seng in particular index and the aircraft stocks drop quite sharply. And as the virus peaked, so peak virus was in late March 2003. About a month later is when we saw the market start to recover and get back on its way, and we saw the market indexes start to bounce ahead. Obviously, the difference this time, it's much more widespread. We're seeing a broad global economic impact here. So it's probably difficult to expect that it's going to play out exactly like SARS. And certainly if we're thinking from a recession perspective and what investment markets look like as far as their response to a recession, Dave has a really good slide that he'll show you in a short time about that. Also, I just want to come back and think as well about the idea of long-term investing. I know you get sick to death of hearing people say, oh, we've got to hold on for the long term when markets are free falling. But if we go back to September 06, and if we were to invest in the Australian share market in September 06, a short time later, your share investment would have dropped by in the order of about 50% with the GFC. But if we fast forwarded to September 2016 and we looked at the 10-year return from 06 to 16, we still would have achieved a 6.7% compounded return per annum. So we still would have actually been rewarded for sticking at it, even in a period of time where the market halved in value. So next slide, thanks, Sarah. So I want to talk a little bit about reserves. I think it's important that we think about reserves, especially at a time like this. We don't want to ever be in a situation where we're forced to liquidate a property, liquidate shares, because we have inadequate reserves to take us through a market downturn. So I guess the question is, how much reserves? How much do we need? And really, that's not a specific answer. It's very much a risk-adjusted answer, depending on your situation. I think if we're looking from a personal finance perspective, somebody who has a reasonably stable income may be able to have reserves in cash of between 3 and 6 months to protect them against interruption to their income. Whereas a retiree, that figure could look more like 1 to 3 years, because ultimately, if markets have a correction like what we've seen, we need to be able to draw on some of these liquid reserves to be able to get us through until the market recovers. Also, we need to think about interruption to income. Yes, there will be interruption to potentially to incomes on commercial assets. There will be dividend cuts, but ultimately we need to give ourselves time so those things can recover. So question, if our reserves are not sufficient, what do we do? And I've just got a few ideas for you. So one, refinance loans while we have 2019 financials to put our best case forward to get credit decisioning. If trading conditions are deteriorating, it may be worthwhile getting in and doing something sooner rather than later and using those financials. Of course, we've got the 6-month loan repayment freeze. So I've made some inquiries. APRA has directed the banks that if you are applying for this relief, that they can't treat that repayment holiday as being arrears on the loan. So I think that's important if we're thinking about needing to get future finance and not wanting to be discriminated against for taking on board these stimulus measures. The other thing is just look for loan cuts, just ask. So a lot of the banks are offering 100 to 200 basis point rate reductions on existing facilities. You just need to get onto your banker and relationship manager and ask for some of these things. Also, just something for your team. If you are laying off staff, if you've got team members that have been stood down, they do have access. And I did see the question earlier about super access. So yes, if an employee is stood down while waiting for trading conditions to improve, but haven't been made redundant or haven't been terminated, those employees, if there's a 20% reduction in their hours worked, they can access their super up to $10,000 via the MyGov site on the ATO. So opportunities to create reserves for your employees as well. Coming back to the income streams, I know Justin touched on this, but it's worth thinking that if you're a business owner and you're in the transition to retirement phase, especially over 60s, think about transition to retirement pensions. You only need to take the minimum by 50% for this financial year and for next financial year. That means that if you're struggling to fund those pensions from the liquid reserves in the SMSF or in your super fund, then rather than liquidating assets, you do have an opportunity to reduce the level of pension payment. So just a word on budget. Next slide, thanks, Sarah. So we have a bit of time on our hands now, potentially, when we're at home. It's probably a good time to come back and think about how you do personal expenditure and budgeting. So what we look at there, often most of our clients, they pay all of their expenses on the credit card, get to the end of the month, pay the credit card out in full and see that as fairly sound financial management. We think you can do better than that. We like a system where you direct all of your income, personal income, into a single focal point, that you pay all your fixed costs, bills out of that account, and then you have a separate account for day-to-day expenditure. Because generally speaking, where we see most of the overspending from our clients, it comes in the area of day-to-day expenditure. So if you're putting a defined cash payment into a regular daily living account each week, then you can have a better handle on whether you're meeting your budget. And also, you don't have to, start taking wads of cash out and spending cash. You can still put a Visa debit or a MasterCard debit on one of those accounts and tap and pay using one of those. Investor behaviour. Thanks, Sarah. So if we look at, from an investor behaviour perspective, obviously there's a lot of herd mentality when markets are dropping. And we've certainly seen some irrational things. If we look at the Aussie share market as an example, we've seen the lines out the door at the supermarket. And as a result, some stocks, even if I use an example, Metcash shares, which supply groceries, they're a wholesaler to a lot of the independent grocers. Their share prices bumped up by about 50%. And you have to kind of question, is that a rational move from an investment decision-making perspective? If we look at those shares, are they actually going to stay like that? If we consider that it's only a quarter of trading that's been done at a phenomenal level, yes, they've sold a lot of toilet paper, but is that going to be a sustainable thing? And then on the flip side, we look at things like airports and REITs have been highly discounted. And yes, airports are going to have less air traffic for 6 months, maybe reduced now that we're getting the hang of this Zoom thing. Potentially, REITs are going to have interruption to their rents beyond the next 6 months, but is that a reason to discount these types of assets by 30 to 40%? Next slide, thanks, Sarah. Loss aversion. So Daniel Kahneman, you've probably read the book, but loss aversion, we feel more pain from a loss than we do from the pleasure of getting a gain. And I think that's probably important more than any time than now, that what type of decisions that are you making at the moment that are based on the idea of loss aversion, where you're trying to avoid further loss and not putting yourself in a position or positioning yourself well for when things recover, where there might be better upside. Next slide, thanks, Sarah. Confirmation bias. So when we come to looking at investor decision making, what views have you formed over the last little while that you are confirming through media and through other chat and talking to other people, and maybe framing your decision making with the wrong bias to what the correct level of action is going forward? And then next one, Sarah. So obviously at the moment, you're quite busy in your businesses. There's a lot of there's a lot of moving parts that need to be taken care of. Everybody's needing to dig a little bit deeper to make sure that they're supporting their clients, that they're supporting their team. So that means you're time poor, and that's probably not going to get better anytime soon. But I guess I just wanted to point out here, are there some longer term things that you're working towards that require you to accumulate assets, to invest, to do some positive financial actions on the personal side outside of the business that you may not be doing just because you're time poor? Is it time to maybe outsource some of those things? Is it time to maybe sit down and put some timeframes on achieving some of those objectives around assets that you want to accumulate, whether it's a property purchase, and start to put some of the groundwork in place to get those things done? And then finally, being in the right places. So Dave is going to talk a little bit about Discover's view on some of the things we're looking at in the market to try and position for the recovery, making sure that we don't have a situation where we've been disciplined to hold on and hang on through the crisis, and then not considering some of the minor tweaks or the 1%ers that we can do to make sure that we're positioned to make the most out of the recovery. So we'll circle back. I saw there were some questions that people have given through my session. We'll look at those in question time. I'll throw it over to you now, Dave.
Yeah, thanks, Matt, and good morning to everyone on the line. So I'm just going to quickly go through where we're at in the market and what we're seeing to date and how it compares historically, and then, as Matt said, where we're positioning ourselves to try to take advantage of this when it does turn around. So the chart that we can see there is the All Ordinaries Index. It goes back to 2015. What we can see is that from the high that we hit in early 2020 at about 7,300 points, we've now crashed down into a correction or bear market, and we've fallen 37% to yesterday. The volatility in this market is extreme, and as a result, we actually ticked over 5,000 points today after what we saw overnight in the US. So we're seeing a market bounce around at all-time highs in terms of volatility. So it's really concerning a lot of people, and no doubt a lot of people do have concerns about what's happening with their investments, and in particular superannuation. So I thought I'd just quickly talk about what's the cause of this. I think we all know. I think Scott Morrison last night mentioned it, and his quote was that this is a health crisis above everything, but the health crisis has caused an economic crisis. So we could talk about a lot of things to do with the virus and what's happening, but the one thing that I'd say about the information around the virus is, if you are reading anything, try to keep it level and try to read as much positive as what you do negative, so that you can make your own opinions, and that's certainly what we do to try to test case positive results and negative results coming out of this. But just very quickly on the positive news, we saw yesterday that Wuhan is set to reopen in April, so they'll be letting residents come and go. So that's really interesting. And also we saw Italy's death and infections decrease on the daily increases. So that was really positive as well. If we compare what we're going through now to what we saw in the GFC on the next slide, the highs weren't too dissimilar. So the GFC, we saw a top of just under 7,000 points. Similar to what we've seen in this market is that it was at the end of a very strong bull run as well. So a market that was trending up, which probably accelerates the correction. During the GFC though, it was a much longer drawn out correction. So when we first went into the global financial crisis, we didn't really know what the problem was. And a lot of it was becoming uncovered as we went through the period. So one of the biggest examples was when Lehman Brothers collapsed. Now, Lehman Brothers collapsed almost 12 months into the market correction. So that gives you a sense of how slow the information was being released at the size of the problem during the GFC. given what we're moving through today as a comparison to the global financial crisis, we can see that the reason for a quicker decline in the market is really because a lot of the information is known or is coming out very quickly. So markets do tend to price that in and they tend to take a worst case scenario when it comes to pricing. So that's where we have seen a much shorter and sharper correction this time when we compare it to the global financial crisis. Just as a bit of an important note on these slides and with the All Ordinaries, because we did hit that high, which is quite similar to the high we hit earlier this year, these do not take into consideration dividends. So it's not a total return graph. This is just the capital price of most of the shares. So when we go through these times, we get tested, and a lot of the time we think about whether we should be making changes. And on the next slide, one of the things that we highlight to our clients is that we do need to stay invested. It is hard to try to pick the bottom of the market, and it is also hard to know how much, if any more, we've got to go on a market decline. As I said before, the markets do tend to price in a worst case scenario very quick, and therefore, you know, with the release of the information that's been positive over the last 24 to 48 hours, we have seen markets bounce 10%. Now, I'm not suggesting that we have seen the low. It's very likely that we might see markets come down further. But if, for example, that does end up being the low in this cycle, a lot of people would have sold out of their investments on Monday because it was a real moment of fear. The announcements that came out from the government over the weekend really put a lot of fear into a lot of people. So all of those people that have made changes to their strategy or sold down investments in Monday, they've now missed the bounce in that market. So again, whilst it might not be the low this time, when we do hit the low, we do tend to see a very quick recovery by anywhere between 10, 15 to 20%. So it's very hard to try to pick the bottom of the market. And this graph does highlight that if you were to switch your investments out of the market and you were to unfortunately do it at the bottom of the market, if you then stayed uninvested for the next 12 months and re-entered the market, you can see that the result over time can be quite significant. Just a couple of comments around why this could be a very short-term market correction. It is going to take us time to come out of this. Business is going to be impacted. I know small business is going to be impacted the most, and revenue in the larger sector is also going to be impacted. But we're seeing record amounts of stimulus. The stimulus is coming very quick and fast, and we're going to see far more tranches of this stimulus flowing into the market. Scott Morrison as well last night made it clear that he wants to keep as many businesses open as possible and trade through. And we all saw Trump's comments as well about the fact that he actually thinks we could come out of this again soon. So, and one word that I saw at the start of this presentation that someone put up on the screen was sympathetic. And I think that's a big point about what we're seeing with really the world population, but certainly we see it in Australia. Everyone's actually trying to support their small businesses at the moment. So whether it be cafes, whether it be restaurants, you know, we as Australians in particular, we will support these businesses when we come out the other side. So just on the next slide, and I'll start moving through these quick, but it really shows the fact that the market is really starting to treat different companies in different ways. So Matt mentioned about Metcash and Woolworths being supermarkets as well. They haven't really seen any impact of this. Woolworths is a company that 5 years ago no one wanted to invest in because of the competition coming from Europe and the fact that they thought their margins were going to be cut. Commonwealth Bank, as all the banks have fallen in line with the market, so down by about 30%. And then Qantas, We know why Qantas has fallen, but the valuation put on Qantas at 30% of what it was valued at 3 months ago, that actually values the company less than what their frequent flyer program is worth. So whilst I'm not recommending to buy or sell any of these individual assets, what this demonstrates is that investments are getting treated differently, and therefore we are starting to see opportunity present within the market. So we think we need to stay invested, and on the next slide I'll show you a particular asset class that we're looking at. We need to stay invested through this, but staying invested doesn't mean holding every single investment the same. Given where we've come from and where we're heading into, we will see a difference in performance between particularly the large investments on the market and the smaller investments. So at a particular point in time, we'll start moving money into smaller companies where historically we'll see that their performance will far outweigh the larger companies over time. So that is one thing that we're looking at. The other things that we're looking at on the next slide, the Australian dollar hit a low last week of 55 cents. That's been a gradual decline from 2011, where we were trading up at around $1.10. So why that's important is the fact that that has boosted all of our returns on our international investments. And we're not sure if the Australian dollar is going to go that much lower. Particularly if we start to recover, the Australian dollar will typically increase in value. Fixed interest, defensive assets, big part of a lot of people's superannuation. There's a lot of concern for that because we're going to start seeing a credit crunch. We've already seen credit spreads widening. And as we start seeing more and more companies become insolvent or have trouble repaying their debt, the fixed interest market is going to become a really interesting area. That's the big concern when we move into recessions, and that's something that we need to keep an eye on. I'll probably end it there. The other areas that we're looking at are just the unlisted assets in the large super funds, and also above everything, just trying to grab value investments that we know will recover and will provide value over time. But happy to answer any other questions or specific questions people have on the markets at the moment.
Thanks, David. That's fantastic. So we are getting quite a few questions coming through on the webinar, so I appreciate those. We've answered a couple just as Dave was talking then, but I might just recap a few. Firstly, we're making a recording of this presentation, and that's going to be available for everybody to access afterwards. So if someone's asked about the slides and the content, so that'll be available for everyone attending. One of the questions we had was in relation to the up to $250,000 loan from financial institutions, which is half guaranteed by the federal government. I think a couple of points. So firstly, you need to use the same bank as your main trading bank, and they will be separate loans to the current loans that you have. But a good friend of mine made a comment, who's listening to the webinar as well. He's in specialist reconstruction of businesses. You want to make sure that the underlying viability of your business is still there. So you want to make sure that, you know, I have clients, I have some income coming in the door. You don't want to be borrowing money and potentially risking family assets and the family home if you don't think that your business is going to get through these particular times. They're obviously discussions we can have offline, but I think that's really important to assess the implications for your business. Another question was around the payroll tax timing and the refund of when this money is going to come back from the State Revenue Office. And we were on the phone, one of our team was on the phone for 2 hours yesterday, and the State Revenue Office are contacting businesses this week. If you're not contacted toward the end of the week, you'll need to contact the State Revenue Office, and we can assist with that. But those funds are meant to be coming back this week to businesses. So Daniel Andrews made that pretty clear that that's what he wanted to happen in a pretty quick time frame. There was a question in relation to if the income of a trust as opposed to a sole trader had reduced. That was from Isabel. And I think the important thing there is that I assume the question is about, would you still be entitled to receive government support as an individual? So the trust is not entitled to any support, obviously, but the individuals, if they're not going to receive any amounts from the trust or any other wages, well, then they could apply to Centrelink for the job seeker allowance if that was the case. But I'm assuming I've answered that question correctly. Dave and Matt, are there other questions there you'd like to look at answering?
I can see that. So I think Jason's got a question about the job seeker payment. So I looked at the Services Australia website yesterday. As far as I can see, it's going to be treated like normal Centrelink income testing, where there's a couple's income test. So I think from memory, the figure was somewhere in the order of about 50, just over 50,000, 53,000 combined income is the test to be applied to confirm if a member of a couple that's unemployed is eligible to receive the payment. So once your income exceeds that test as a couple, there's no payment.
Right. Okay. Thanks, Matt. And also just to clarify for Travis, how the payroll tax refund is being calculated is the payroll tax that's been paid from July last year to now is the amount that's going to be refunded by the government, the State Revenue Office. So that's the payroll tax query. Non-residents, Matt and Dave, are you aware of any protection for, I'm assuming, will non-protected Australian residents get any help at all?
Not that I'm aware, Dave. Have you seen anything?
No, I haven't seen anything on that. So, but we'd have to look into that specifically. I can't say either way.
And then a question about, we have a question from Simone about job seeker affecting your credit rating.
I guess in the end, we're a little bit at the mercy of the opaqueness of credit decisioning in banks. I mean, as I said before, with the loan payment 6-month relief on home loan repayment. So just to clarify before, so the interest does capitalise on those loans. So you're not getting a free hit interest wise on the loans. But as I said before, APRA has directed the banks that those loan the repayment holiday be not treated as arrears. I guess coming back to past experience with Centrelink payments, banks will actually use Centrelink's payments to look at serviceability calculations for loans. So my initial reaction would be to suggest that I would think it doesn't negatively impact you as from a loan perspective, but happy to get our loan specialist to look into that as well. Chris Ravjan can just confirm that for sure.
That's good. Just back on the loans, and that's the government loan of up to 250. Ben had a question in relation to using the same bank, which I mentioned before, and then also to are there any rules in place to stop consolidation of other loans? So a few clients have asked, like for example, if they had a couple of plant equipment loans for cars, say there was $50,000 of a work van, and then they borrowed $100,000 from the bank next week under these new government guaranteed loans. Our understanding is there's nothing stopping you using those funds to repay existing debts. So we will obviously clarify that, but that's our understanding at the moment. Refund of PAYG is another question that we've got. You'll only get back what you've paid in PAYG. So initially, and we just need to clarify a couple of points there, but so there's not just a handout to each business of $20,000. It comes back to what your PAYG amounts have been paid, but we've got from now till, my understanding is from now till June, for a lot of that PAYG to be coming back as well. Matt, any other questions there that you...
Not that I can see. So there's a question, I think, from Duncan about the lack of clarity around the second stimulus announcement so close together, and is there a good way to resource? Is there a good way or a resource to clarify the effects or changes the S2 announcement, Stimulus 2 announcement has on the measures detailed in Stimulus 1? Justin, I don't know. I might throw that back to you. Actually, I did see a good table on one of the government websites that did table out all of the stimulus payment measures and the dates that they're being paid. So maybe we might be able to share that to the group later. And that seemed to summarise things fairly well. But I don't know if that helps, Duncan, with your question.
Yeah, and also too, we've really treated the presentation today as a combined presentation around the 189 billion two packages. And I think the important part is there's been some clarification now around timing, so timing of the payments. And one of the questions from Chris is in relation to PAYG. If you employ someone who's lost their job, as long as you were employing from the 1st of January and you were employing other people, just because you hired someone this week, you'll still get a rebate of the PAYG for those employees in this March month. And then we believe that'll be ongoing up until June as well.
Great response there from Matt Kerr. I'm assuming that's Matt Kerwin-Hamilton. So people should be looking for the opportunity during this unusual time, or that may come after. There are many, but you won't see them if you don't raise your eyes in between worrying. So yeah, definitely echo that sentiment that we do have to watch our cognitive biases. It's very easy to get caught up in a confirmation bias circle and to miss a lot of the opportunity that does exist when we're in the trenches and just can't see the forest for the trees. Throw in a litany of other throwaway lines on that topic, but
I think it is. Yeah, I think it is a great comment, and you know, there's definitely opportunity out there at the moment for people to look at, and I think that comes back to the comments around make sure that you do keep yourself informed, but try to balance what the information that you're informing yourself with, because there's plenty of people out there saying that we will move through this and we'll get through it, and certainly when we look back, it might look like a small time that we had to struggle through. So, you know, keep in mind that Wuhan's moving out of this, and I think that's really a positive sign that you can get out of it. So great comment.
Just in relation to that, I'll come back to the comment I made before about the businesses that are prepared for the rebound in the economy, and the ones that have that are viable and have sufficient cash to do so are the ones that are going to recover the quickest. So it's about being in a position with your business to ensure that you're able to take advantage of that. One of the comments I made too, just to some clients over the last few days, is that, you know, I'm a landlord myself, but you know, in relation to your business, asking your landlord for potentially some reprieve in relation to some assistance for rent. So looking at minimising outgoings for your business, and how do you do that? Or speaking to your landlord, looking at some of the other costs and overheads that you have in your business. I know a lot of people have been looking at that. I think that's just a general comment that you should potentially be asking for some rent reduction or relief for a period of time, just until we understand the timeliness of the time frame of how long this is going to last for. The PAYG, Travis has asked a question about PAYG. It's calculated, my understanding, from January, not from July last year. So it's this last quarter. You'll be getting a rebate from January, February, March's wages, basically, for PAYG up to $50,000 in this first payment. And I think we're almost running out of time, gents. Is there anything else that you'd like to run through? Any other questions or comments? Not from Dave or Matt. We would like you to jump onto Menti again, the menti.com. and I think the code will come back up again, 866028. Just two things. So any feedback for us, and also two topics for next time. So what would you like to hear us talk about? We're looking to have these webinars on a semi-regular basis. So we'd like to know, you know, as the economy keeps moving and stimulus changes, I think we'll be coming back to you with additional webinars. I do know, just as a bit of a plug, Discover have a market update this Friday, gents, correct?
Yeah, that's right. So we'll be doing that. It's Friday, 11 a.m. I think, or it might be 11:30. But we can post to the group so that anyone that wants to attend, they can jump on that as well.
I think when we send the recording out, we'll let everyone know of that timing of that for Friday as well.
Mm-hmm.
Okay, I'd like to thank the presenters. Thanks, David and Matt, for your time. I think someone's made a comment just about implementing. Exactly right. I think it's this is about being on the front foot. One final comment I'll make: in the GFC, I didn't make changes quickly enough, and I think that's something I didn't regret. But if I look back, that's something that I would have done differently. So take that on board and apply what you've learnt today and what you've been reading into your business. And I think we've definitely provided some food for thought, and thank you for the comments, and thank you everyone for attending, and we look forward to speaking to you all soon.
Thank you.